Come on. 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, April 16th, 2022. We had another great week of shows with great contributors, and we kicked off the week with a look at how to support military caregivers. Let's take a look.
I can sure tell you about them because I am one to a veteran who spent 23 years in the Army. So I think first, there are 5.5 million military and veteran caregivers. So I don't think that we really take time to think that there are actually military caregivers, right? I think when you think of a service member, a veteran that's been wounded or ill due to their service, you think, oh gosh, maybe it's the VA that's taking care of them, right? But if they are, at the same time, they have a family that is picking up those pieces after they may get care at the VA. We've got those invisible wounds. We have physical wounds as well. Can you imagine these caregivers that have had no professional training doing wound care to someone that is an amputee? That's not something that we were taught. What about caring for someone with those invisible wounds? What about PTSD and, depression, suicidality? It really affects the whole entire family. And I don't think our communities really think about that and look past our veterans. We take really good care of our veterans in this country. But I always say, when you think a veteran, if they've got somebody standing beside them, thank them too. I can almost guarantee you they're taking care of a lot behind the scenes. Well, as you said, their foundation and Bob Hope had a lifetime legacy and has left a lifetime legacy to really taking care of those and supporting the troops. So one of the things that they wanted to do, one of the things they first did with the Elizabeth Dole Foundation is a little over a year ago, they provided funding for our Hope for the Holidays, where we provided caregivers and their families with $500 to $1,000 grants right around the Christmas time. It was right smack in the middle of our COVID pandemic. So it really, really supported so many caregivers. But what we found was that where we wanted caregivers to take that money and provide Christmas presents for their children and their family, they weren't. They were using it for food, rent, mortgage, car payments, bills. So that is when we came to the realization and went back to the Hope Foundation and said, can we do more? And with a gracious gift of $500,000, we were able to launch the Hope Fund for Critical Financial Assistance at the Elizabeth Dole Foundation, which just launched on Monday. And we are seeing great success. I am just honored and blessed to be able to administer this program, which we are in hopes fills the gaps that maybe other organizations or local support services doesn't fill. So maybe those larger grants, maybe something such as a child in a veteran home doesn't have dental insurance, but they need a procedure done, but they can't afford it. We want to be able to provide that for them. So the caregiver applies, and we have gotten applications for mortgage assistance, rent, food, utilities. Some of the applicants don't have a stove or refrigerator. They need repairs done so that their veteran can get around better in their house. It's been fabulous. What is this, Thursday, 4 days into the launch, and I have 161 applicants in the system at this point in time. You can go to hiddenheroes.org, and then under our help, you will see the Hope Fund, and it tells you all about the fund as well as has the application. Click here button, and that will get you to the application so that you can apply. So first, this program is open to all eras of veteran caregivers, and they are the actual ones that are filling out the application. So not the veteran, the veteran caregiver. We do require proof of veteran service that you have to upload, such as a DD-214, VA benefits letter, something like that. And we do pay the vendor. Therefore, we need, like you said, a copy of an invoice or an estimate. Say you are getting dental work done. Most of the time we get an estimate of what that is going to look like for us. So something on those lines.
And we also discussed increased charitable giving during the pandemic. Let's take a look.
I think, the results surprised us as well. We went into this project kind of not knowing exactly what to expect. There's kind of like two streams of research that make opposite predictions. There's one stream of research that says when people are faced with a threat, they kind of turn inward, they become more selfish, they look out for themselves. And there's another stream of research that says the exact opposite, right? That when people are faced with a threat, they kind of engage in what's called catastrophe compassion. They help each other out, they become more giving. And so we were kind of curious to know, in the context of the COVID-19 pandemic, which we would find in the context of financial generosity, at least. Americans did seem to help each other more. And as you mentioned, it's incredibly surprising also in light of the kind of financial situation that's accompanied the pandemic. And in fact, there were some expert predictions that due to the financial kind of collapse associated with the pandemic would lead to a reduction in charitable giving. And in the United States, there's been a long-term pattern of charitable giving following kind of the underlying economic health. In 2000 and during the 2008 recession, giving decreased. And so this actually breaks the long-term pattern of charitable giving in the US, where giving increased despite a worsening kind of economic situation. We're not entirely certain the exact what the exact reasons are that drive that difference, and I think that's something that's kind of important, perhaps for future research to try to investigate and look at when, exactly like you said, when the reaction is kind of more selfish and when it is more generous. I think that's kind of still a debated question in the literature, and in fact, even with this pandemic, during the early days, especially, we saw people kind of hoarding toilet paper and masks. So there were also some selfish responses even during this pandemic. But the question of when to expect selfishness or generosity is a very interesting one, and I think it's still kind of an open question of when to expect which reaction. In our data set one of our data sets that we use to analyze this question is from charitynavigator.com. We actually saw that in the year 2020, giving that was in memory of someone was higher than at any period before. So it is indeed possible that those kinds of feelings of sympathy may be driving this kind of increase in giving. Is also, there are kind of other related reasons that people may want to just simply kind of feel positive emotions associated with giving during a time when there might be a lot of negative emotions swirling around.
Well, we're halfway through. When we come back, we'll take a look at the other half of our great segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. This week we also took a look at Swedish retirement plan investors' trading activity during the pandemic. It might surprise you. Let's take a look.
Yeah, what we look at is the trading behavior of Swedish retirement investors. And the way this works is every Swedish employee has to put part of his salary into a pay-as-you-go scheme and another part into the premium pension. And that is something we look at. The premium pension, that's a funded scheme. Investors can select amongst roughly 500 funds. If they make a choice, if they don't make a choice, they get the default fund.
And the default fund, I think, is it like a target date fund, what we would call here in the States a target date fund?
It is a target date fund, and it's considered to be a very risky fund. So it's a leveraged fund. It tracks an index, but with leverage. So it moves up and down more than the market, especially for young investors. Now, what we typically observe for retail investors is that they panic, so that they would start trading a lot, moving out of certain stocks and assets into more safe assets. That's what we observed in earlier periods. And now when we looked at the data from the Swedish retirement investors, and I think we talk about roughly 8 million people that are a part of the plan,
wow.
Almost nothing happened. So we saw initially that some moved out of equities into seemingly safe investments like bonds. But when we looked at the numbers, the fraction of investors that traded, it's almost nothing. So we observe that 2% of these investors did something at all, while in normal periods is 1%. So economically, we would say nothing happened with them. Now, we do know from different studies that the average Swede has a higher financial literacy than compared to other countries. That's something that we know. But based on the analysis we run, we like to tend to believe that it's rather the system design, the choice architecture in the system that makes these investors highly inert. So the system gives a lot of incentives. Let's put it like this way. Let's explain the system a little more. Now, if I give you the choice out of 800 funds, that was 2 years ago, now it's 500 funds, what do? Do you do your math and study and compare 500 funds? Probably most do not. And Nobel Prize laureate Dick Thaler actually when talking about the system, he would say nudges that work forever and nudges that make you do nothing. You stay with the default because the system creates so many choices that people feel choice complexity, choice overload, and the natural reaction to that is do nothing. And that is what we believe is going on with these investors. They are educated, they are led to behave very inert. When then such a crisis comes, they just follow the path of least resistance and continue what they did doing beforehand. They do nothing. That's what we think, that the choice architecture of the system makes people lazy. We can argue about whether it's a good thing or not. But in this particular period, we think that's actually a good thing. Now, that probably depends how much you narrow it down. So the number of funds in that particular Swedish system has been narrowed down from 800 to 500. I think the most recent number is something 420, which is still way too much to have a clear idea what to do in a particular situation. I can imagine if you make it very simple, 3 funds, 3 options that differ dramatically, that you might take the time to look into these options and maybe based on that do something. But the way the system is right now, this is far from happening.
And finally, we took a look back at our recent archives to take a look at what you need to know about the House's passage of Secure 2.0. Let's take a look.
So Jeff, it's really exciting that Secure 2.0 passed the House last week. It passed with broad bipartisan support. I believe it was 414 to 4 in favor of passing the legislation. What's nice about this is that we talked in 2017, 18, and 19 about how rare it is for retirement legislation to have real momentum. And looking at Secure 2.0, it seems that there's a fair amount of momentum. And having gotten through one chamber, if it can get through the Senate as well, there's a real chance it can become law later this year.
You're absolutely right, Jeff. It basically is, with some carve-outs here and there, designed to basically say, in order to be a valid 401k, in other words, in English, qualified, so meet the IRS rules, you will have to put in, for new plans, automatic enrollment. So people have to be automatically enrolled at potentially 3% or more, and it's designed to facilitate savings. I will say I think that is a big change, but if you look at the vast majority of large plans and increasingly a lot of smaller plans and especially pooled employer plans and MEPs, you see a lot of people already doing automatic enrollment. So I think it will help move the dial in some ways on newer plans, but I think in a lot of ways, it's going to sort of affirm the steps that many plan sponsors have already taken to try to get their folks into plans. So I think that's kind of the key takeaway on this at this point.
And this is a really significant change. When we look at the retirement system, there's a real focus on reducing the risk that individuals run out of money. And there's really 2 ways that we can reduce the risk of running out of money. One would be to have higher account balances, which I think we all support. The other is to shorten the period of time where people are required to take distributions or take distributions from their retirement accounts. And in some ways, it signals that folks are working longer. But, prior to Secure 1.0, the age that people took distributions were required to start taking distributions was 70 and a half. Now it's been moved up to 72. And what Secure 2.0 would do is it would allow retirement savers to, essentially keep their money inside their plan longer. And, this isn't an immediate jump, but over the next 10 years after passage, it would essentially raise the RMD age from 72 to 75, which, on the one hand, it means there's fewer years that they'll be taking money out. And then on the other side, it provides for more years of compounding for retirement savers to have a higher account balance.
I think it's good to keep in mind because you get lots of studies out there. For instance, DCREC has its 22 DCREC defined contribution study. And when you look at these studies, catch-up contributions are very widely used and they're adopted very broadly and across many plans. There's very few I know of that don't have them at this point. But at this point, catch-up contributions, there would be some changes. First of all, a key one is that catch-up contributions, you'd have an extra bumped up limit for people who are nearing that age 65 in those last couple of years to be able to put extra money away to basically enhance their savings, a little goosing at the end, which especially if we have a down market at some point and it's before retirement, it's a way to help people to try to recover as best as possible. Similarly, because of the funding pieces in this, which you alluded to already, Jeff, there are changes about things like catch-ups being made into after-tax Roth-style contributions, and that's another piece that we're going to see as we go forward. Because in the world where we have run up a lot of debt, these bills try to pay for themselves as best as possible. So those are two things to keep in mind. But if for retirement savers, as Kevin said, I think it will be a great opportunity to increase savings. And also, one other note, for IRAs, it will actually index the catch-up limits there as well. So it's enhancing the catch-up rules and taking them to a new step so that retirement savers of all types, whether in a 401k or an IRA, get enhanced savings.
And there's been a lot of talk about how the federal government can help in solving the missing participant problem that American workers and American companies face. Because really our retirement system is only as good as it is at connecting individuals with the benefits that are promised or the benefits that are due. If those benefits don't arrive, then what are we all doing here? But at bottom, what this does is it creates an avenue where the federal government can have essentially a lost and found, where participants can provide updated information, where the government can help those participants connect with their plans that they may have a benefit from, and then at bottom connect everybody, plan, participant, with their benefit. And hopefully what this does is it signals a bit of a pivot from a world where we're hoping that participants contact their former employers to update their addresses to one where employers and participants are able to go to a central one-stop shop and connect each other with benefits or with benefit requests.
I think it's a pretty high probability, definitely in lawyer speak, more likely than not. There are some differences of things people in the Senate would like to see added to the bill. In addition, there are things that, tweaks, clarifications. So it's not going to be immediate. It could either be June, July, or it might even wait till after the election. That's my take.
All right, Kev, your thoughts?
I think David just summed it up really well. If it's going to pass, and I think the Senate will do their own thing, and then they'll combine it with the House bill and smush it together. But if it's going to get done this year, it's all, in all likelihood, in my view, it'll get done by the end of June, or it'll get done sometime around the holidays in December.
Well, certainly great segments. I want to thank all of our great contributors this week. And that wraps up this episode of BRN AM. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, all in one place and entirely free, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content? Search our archives. Well, check out www.broadcastretirementnetwork.com and our streaming partners like Amazon, Roku, Samsung, over 100 more. We're back again tomorrow for BRN Sunday. We'll be joined by members of the media, academia, and financial services as we analyze all the news and events for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a tax doctor now for a tax emergency analysis.
Call 800-224-6439.